right, hey folks, here, Marziti here with part 2 of our new trader webinar series. In this section, we're going to talk about fundamentals versus technical analysis, the types of different trades we can make, against whom are you trading, and base hits versus home runs. Again, a little bit of dry material, I'll grant you, a little bit of dry material, but very, very, very important. This is kind of stuff that if you don't get this, no matter how dry it is, you're just not going to make it. You got to know as part of forming your game plan, your trading strategies, everything like that. So let's get into it. And as I've said before, I don't have the slide here, but let me just go over the disclaimers. This video is produced by me, Marziti. I am the owner of it. You're welcome to distribute it so long as I am given credit for it. I am not a moderator or financially compensated in any way by the Bullish Bears and their team ownership or anything like that. You are responsible for your own trades, and this is for educational purposes. So with that out of the way, let's get into this webinar. Fundamental versus technical analysis. Fundamentals was the way that it was done before. We did fundamentals because we didn't have the computing power and things like that to do a lot of charting. A lot of people understood charting and different things like that, but the idea of technical analysis just didn't catch on 20, 30 years ago. And so people would get down and they would look at what's called fundamentals. And this would be like profits to earnings, cash liquidity, debts, asset divided by debt, that ratio, things like that, to give you an idea of how healthy a company is. They would look at the returns year over year. And it's important to understand that when we talk about fundamental analysis, we're not talking about day trading. We're not really talking much about swing trading. We're talking about buying and holding a stock or an ETF or whatever and sitting on it for minimum 1 year to 20 years. And that's the way fundamental analysis worked. And in the beginning, like I say, because we didn't have charting, things like that, all we had was spreadsheet kind of information. And so that's the way people used to evaluate companies. Now, it is still used today, and many people still use it today, but we would not call them day traders, nor would we call them swing traders necessarily, unless they're using fundamental analysis for a swing trade that might go on for a month or 2 or 3, that kind of thing. We'll look a little bit more of that in just a second here. But then along came technical analysis. Excuse me. So technical analysis was the idea that trading is more about psychology, the crowd mentality, and the idea that there were certain predictable patterns because people can be predictable in large numbers. And this turns out to be very true today. Technical analysis is used by day traders every day, but it can also be used for swing trading and things like that. We look at the chart and we pay attention to the short-term breaking news. Now, what does the news have to do with it? Well, people trade based on the news. If a company does their quarterly reports and everything is fantastic, all the boxes are checked and blah, 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 we expect, based on that report, we would expect the stock or the ETF to go up in value. Now, a lot of times, though, there's a saying in technical analysis that the news is factored into the price. The news is factored into the price. Fundamental analysis does not consider news unless they're waiting for reports. And, for example, if you're looking at a a biotech company, most biotech companies will start developing a product, a prosthesis, an artificial tube that connects the liver to something, whatever, gene therapy. Now, these biotech companies know that it could take them 5 years, let's say, to either, figure it out or go bust. So they look for people to invest in their company. So people might come in and look at their fundamental analysis, and they're waiting for these biotech companies to go through their CDC trials and get favorable reports as they go through a stage 1, a stage 2, a stage 3. But these are things that could take a year apart to happen. Technical analysis, more short term, whether it's intraday or within a week or whatever, we kind of expect to see how things play out. Let's take a look at some fundamental analysis stuff, though. And I'm going to zoom in because this can be kind of hard to see. So we might look at, be still, earnings per share, dividends per share, book value, free cash flow per share. Very important. That's a very important one right there, is free cash flow per share, because that means that they have cash on hand. And you say, okay, what about it? Well, if the ticker turns south, if their stock price starts going down because of some bad news or something like that, do they have cash to keep them afloat while they get through the bad news? Because if they don't have any cash, they start leaning on debt, and then the debt starts piling on, and then the value of the company just plummets like a rock, more and more. Return on equities, interest rates, long-term debt to capital, quick ratio, which is their debt to assets kind of thing. We look for a positive number there, and so on and so on, okay? That is the kind of things you may have heard people talk about, the EBITDA, all these kind of different things that a fundamentalist will look at in a company to get an idea of how strong and healthy is this company. We're looking at Tesla here. Tesla's going to be my little child today, my little poster child for a lot of stuff. So we'll kind of see how that plays out. But at any rate, so we're looking at the books to see how strong and healthy a company is, with the idea that over the long term, notice that this company will continue to do well and improve its stock value. And if it's a high dividender, then hopefully it will return better dividends as well. Okay? But again, fundamentals is mostly for buy and hold, stuff that you're going to hold for at least a year. Now, why a year? Well, it has to do with tax purposes. Because if you buy and sell a stock within the same tax year, if you made a profit on it, you have to pay short-term capital gains, also called ordinary income, which is a higher percentage of tax on the profits. On the other hand, if you hold it for at least a year, 366 days, then you pay long-term capital gains on your profit, which is a much lower tax rate. So that's one of the things about fundamentals that is very appealing to a lot of people, for those kind of people. As opposed to technical analysis, where we mark up this chart. Now notice here in these blue lines, that's a Bollinger Band. I've got a dominant trend line here with a derived trend line down here. I've got a chop zone marked out down here. And we say, okay, well, what does all this tell me? Well, a technical analysis or a technician would say, when we hit, like right here, let's zoom in on that. Notice that our Bollinger Band, we hit not on the Bollinger Band. Well, at this point, that was one of the anchor points for this derived line. So that didn't count. But if we come back over here, we notice there's that trend line. we hit the bottom of the Bollinger Band, and we hit the trend line, we say, okay, go long. And sure enough, on a daily chart, that proved to be a good trade right there. And so that was confluence, where multiple things agree or line up. And so this would be a great go long trade right here. And then when we got up here to the top of the Bollinger Band, we're out. It's that simple. This was the trade. We're done. Okay? It might happen again. Obviously, we see that the ticker skyrocketed. And so what do we know about these kind of gaps like this? You may have heard terms like fair value gap, where you have like this candle number 5 and this candle number 7 don't touch each other in any way. And so there's a gap in between the two. And we know that the markets don't like gaps. And so we see that eventually it came back in. It touched it again. Not it touched this Bollinger Band, it touched this trend line, and then it came into this gap. And what did it do? It took off again. Right? So this is technical analysis. And we say that in technical analysis that the news is baked in, whether it's expected news, though not a lot of times, sometimes it's not that the news will tell us whether it's bearish or bullish, but it oftentimes will tell us how far it will go based on the news. And so that is technical analysis, where we look at the charts and we kind of decide based on, there's all kinds of reasons. And by the way, I want you to notice there's very, very little reason for Tesla to go up here. Why would you go up in this price? It's because trading, in terms of technical analysis, is psychology. One of the biggest things that I learned early on, I think I told this story earlier, but I'm a very technical person and good in math, all that kind of stuff. And when I first decided I was going to go full-time as a day trader, I knew I'd have this thing knocked out of the park, have it all figured out in 6 months. 3 years later, I'm still crying until I finally found the bullish bears and learned about something called price action. I knew about some technical analysis stuff, but I was still missing some stuff, and we will get into that, especially when we talk about liquidity and things like that. But there we are. Technical analysis marks up probabilistic paths. Probabilistic, I can't say that. Paths based on probability. Let's go with that. And we make trades on this. So, we believe that there's a 60-70% chance that this trade is going to go up based on historical of the way it's done in the past. There's still a 20-30% chance we could be wrong. But we're looking in technical analysis to get that 70% win odds in our favor. If we can do that repeatedly, then we can make money with this idea. All right? Let's talk about the types of trades and the terminologies that you'll hear. Pardon me one sec. Let me get something to drink here. Bah, frog in my throat. Types of trades. Now, you'll hear all these different types of terminologies and words and phrases. So I just kind of want to define them. Scalp has two meanings. Scalp can mean, on one hand, it can mean a very, very quick, small profit trade. In other words, I might be in a trade for 30 seconds. I could be in a trade for 30 seconds just to make a small profit and get out. Because maybe I like little small, onesie-twosies, and they add up over time. So I might be in a trade 30 seconds. In, out, that kind of thing. Not home runs, not anything dramatic, but a scalp is, if it plays out right, it's, good money in the bank. An intraday trade is a trade that is opened and closed within the same trading day. Now, if you're trading stocks, ETFs, generally we say that the New York Stock Exchange is open from 9:30 a.m. Eastern Time until 4 p.m. Eastern Time. Now, we know that a lot of stocks actually trade 24 hours a day now, or 23 hours really, or whatever. And there's pre-market and aftermarket and all that kind of stuff. The point being, though, is that from 6 p.m. until 5 p.m. is generally what we consider a full window there, because all markets are closed for at least an hour every day. And that generally that closing time is 5 p.m. Eastern Time. But at any rate, but the point being is that from market open to market close within the same day, typically most people, like I say, think of it from 9:30 a.m. until 4 p.m. Eastern Time. That's an intraday trade. Okay? A swing is something that could last 2 to 3 days or 2 to 3 months. But that's generally, 2 to 3 months is usually it. Most people are thinking in a couple days to 1 to 2 weeks. And then they're out of that trade. And we'll call that a swing trade. The key thing to understand is it's more than a day, and it's usually more than several days. Now, I want to mention that the above types are all the same in terms of what we call fractal. And we'll look at that in a moment when we start. Now, what does fractal mean? It means that the same trading patterns can be found on all of these time zones. We'll see that in a moment. The point being is that whether you're looking at, I see a head and shoulders pattern there, or I see a reverse doji candle or a rally-based drop setup. All of those kind of trading setups can be found in scalps, because they're a lot of times dealing with real short time frames. They may be trading on the 1-minute chart. They may be trading on the 15-minute chart, or they may be trading on the daily chart. And you can find the head and shoulders pattern or the rally-based drop or whatever on all of them. And there is something to be said that it plays out very commonly on all of them, regardless of what time frame you're on, because everybody sees the same thing and everybody knows about it. Okay? So let's talk about earnings. Earnings is something that really a lot of new traders struggle to grasp what's going on. Every quarter, all the stock companies, not ETFs, because ETFs are not stock companies, they hold stock companies, or the stocks from a variety of companies. But every stock company, like Apple, Microsoft, Nvidia, they have a quarterly earnings report. And in that report, they talk about their last quarter. What happened the previous 3 months? Was it good? Was it bad? Why was it good, or why was it bad? Then they'll talk about what they expect to happen in the next quarter, and that's called forward guidance. Forward guidance is simply a fancy term to say this is what we think is going to happen in the next quarter, maybe the next 6 months, maybe the next year. This is very important because we're going to hold them accountable to it at the next quarterly earnings report. If the last quarter they said we expect a 5% growth in the next quarter, well, that quarter goes by and then we come by and see that, well, they had 1% growth. Well, people want to know why. They're angry. They invested their money. They were expecting 5% growth, and they did not get it. And so we would call that a miss, that they missed their projection, their forward guidance from 3 months ago. Okay? Now, the significance of earnings, though, when it comes to being a day trader, is to understand that there are a lot of people that specialize in earnings plays, and unless you are one of those specialists, you get out of the way of it. Because you don't know, I don't know, we don't know what's going to happen when that CEO or CFO hits the market and hits the presentation and makes their announcement about good news, bad news, no news, whatever. Since we don't know, institutions have based all kinds of trades based on that earnings. What if the earnings are good? What if the earnings are bad? What if they're mostly good? Institutions have got plays already set up, and since we don't have a clue what's going on there, we generally want to stay out of the way. So if you hear that NVIDIA's reporting Wednesday night, right after the market closes, don't be in NVIDIA trades going into closing. That is not a good idea, because you don't know what's going to happen. You could get wiped out, or you could make your lottery ticket and buy the moon. But again, we don't know. So, and if you're into options, we'll talk a little bit about options. Some I've got in the next video here is an older recording, but it's still good enough that I'm going to use it, about stocks, futures, options, what the differences are, and we'll talk about options more in that video, or actually two-part video. But one of the things that we can talk about is called IV crush, and that happens right if you're into options trading. You'll learn real quick about IV crush on options on a company that has earnings coming up. Anyway, let's see. What else? Buy and hold. When we talk about the fundamental stuff earlier, this is the kind of people we're talking about. People that buy, a couple shares of Apple, they tuck it away, and they don't look at it. They don't trade it. They just hold it, and with the expectation, let's say that they expect in the next 5 to 10 years, Apple is going to just continue to, blossom and whatever else. And that's called buy and hold. Obviously not day trading. Now, another thing, many people stockpile their money into stocks and ETFs that pay dividends. And in the last couple of years, there's been just a slew of dividend-focused ETFs that have come out. And some of them make the most dramatic claims, like 15 to 20% a year. And I'm going to talk about that in the next video coming up there, where we talk about the stocks, futures, and options, what they are, and so on there. But the point is that we make money with stocks two ways, generally speaking. Number one is simply appreciation. The value of the stock goes up. The Acme Widget Company stock value is $100 a share. I bought 1,000 shares, and I'm hoping that it will go from $100 to $105 this year. Well, I bought 1,000 shares, so that would make me $5,000, right? Because it went from 100 to 105. On the other hand, instead, I would rather put my money into a dividend company, or a dividend ETF, or a company that pays a good dividend, or something like that. And I don't really care if they go sideways. I can handle them going down in value a little bit, but every month or every quarter, some every week, pay a dividend. And many, many, many years ago, that was the idea, was that you would stuff all your money into dividend-paying funds, and that with the idea that when you reached 50, 60, 70 years old, you'd stuff so much money in it that is paying 5% a year, and that 5% a year would be enough to cover your retirement. Of course, most people back then also worked for their pension, and of course their Social Security and stuff like that. And so, they were just stuffing everything they could in there to just boost their retirement. But, I mean, you think about it. If you've got a $1 million account and you buy a 20-year treasury bill that pays 4%, you're going to get $40,000 a year. And that's the idea with dividends. So, okay. All right. Let's talk. I mentioned here about this fractal business. So let's go take a look at that. I want to show you here. This is a chart of Tesla. This is Tesla on a daily. Now, here is the trend line. This is the derived trend line. In other words, I take this trend line here, which has 1, 2, 3 contact points. I take this line, I copy it, and I paste it, and I look for where it intersects a lot on that exact, that same angle. Well, it fits pretty well right here. All right? And you can see what kind of happens. We move from the top of the trend line to the bottom, to the top, to the, it's kind of moving in this channel. All right? So that's a channel. Okay? Well, here's Tesla on a 5-minute chart. Top to bottom, top to bottom, top to bottom. Moves in a channel. And the same thing can be said, we can find it. You may know some of these chart patterns already, like the head and shoulders. We've mentioned about the fair value gaps, the rally-based drop or the drop-based rally, all these other kind of trading patterns here. You'll find as a day trader or a swing trader that these same kind of patterns, whatever they may be, or Bollinger Bands or RSI trades or whatever, show up on just about all time frames, even monthlies and weekly. And that's what we mean by trading patterns are fractal. They appear, you'll see it because, again, it's all psychology. And some people are trading the 1-minute chart. Some people are trading the hourly chart. And some people are trading the daily chart. But they all know about the head and shoulders, the rally-based drop, the this, the that. And so they're looking for it. Even, so once you learn all this kind of stuff, the time frame doesn't really matter that much other than your patience. So here we are about earnings. I forgot I had this slide in here, but let's just see. Past quarter performance, past quarter expenditures, forward guidance. The CEO is going to make a speech. And in that speech, and then there's usually a Q&A session that follows. If the CEO or sometimes the CFO is doing the presentation, if they slip up and say something stupid or something they didn't mean to say or whatever, you'd be amazed how many times a stock's price can have a knee-jerk reaction just because everything looked great and then the CEO said something wrong, and then within milliseconds the algos, the institutional algorithmic computers are actually listening to that CEO's speech, and if they interpret something that he or she says as, wait, whoa, red flag, they'll just immediately sell the stock. They'll start a selling thing going right off. I've seen it happen. Institutional moves. Now, what do I mean here? I mean that the institutions like your Morgan Stanleys, Bank of America's, and all these others are listening to all these kind of earnings announcements. They have a trade already set up. And that trade is already, like I said, it's already set up to happen. In many cases, they really don't care what the CEO says. The institution may be planning to make a bearish move on that stock regardless. They're just waiting for the CEO to post for the company to post the numbers. You say, why would they do that? Because they know other institutions are doing the same thing. And they don't want to get left out, or they think they can beat the other institutions. You'd be surprised that a company could have the most dismal, horrible report, and yet the stock rallies and rallies and rallies, and you're like, I don't get it. Why would the stock rally when they said they just lost all this money or whatever? It's because the move in many cases has nothing to do with the report. It is the timing of the report, and that's it. And that's the hard thing for a lot of people to understand, and that's one of the reasons we say get out of the way. Don't be in a trade, the moment that the earnings announcement comes, because we don't know what's going to happen. Let's talk about the rest of the types here. We talk about the buy and hold. We talked about the capital gains. Short-term capital gains, higher taxes if you hold it for less than 365 days or whatever. Long-term capital gains, if you'll hold it for at least a year, you get lower taxes on your profits after you sell it, right? We talked about appreciation, dollar for dollar. Dividends can be taxed. Yeah, dividends. Oh, let me mention. Oh, boy. There's a thing called, there's qualified dividends, non-qualified dividends, NAV dividends. There's all kinds of different dividends on a company, and it has to do with how they are taxed. Some dividends can be taxed at regular ordinary income, short-term capital gain. But there are some types of dividends that come especially from municipal ETFs that support local county governments, for example, that at the state level are always taxed at long-term capital gain or even not taxed at all. So this is just... they're just, dividends can be taxed in many, many different ways. So if you're really thinking about getting into dividends, you need to research what it is. Do some research, see if AI might help you out. Talk to your accountant or whatever and get some advice on, and they'll tell you how this, Ford pays a dividend, let's say. How is Ford's dividend categorized for taxation purposes? Now, I don't actually know the answer to that. But if I were going to sink a lot of money into Ford just for the dividend, I'd want to know that. I'd want to know that because if I got two companies that pay the same dividend and have the same stability, but one of them is very tax favorable and the other is tax horrible, well, we need to make sure we put it in tax favorable, all right? Okay, now let me talk about this dividend trap for just a moment. I'm going to jump over here, and I want to pick Yield Max Coin. I don't know anything about Yield Max Coin. That's not what I want. I want the summary. But I see exactly what I need to see. Let's go into this. I haven't looked at this, but I want you to look at this very closely. Do you see that the yield supposedly here is 179%? You're like, holy grail, man, I found it. I found it. This is awesome. February 2025. The stock was at $122. Now it's at $41, $42. Remember that your yield is paid off of the value of the stock at the moment the yield is declared. So if they're like in YieldMax here, if they're declaring this yield every month, then at the beginning or at the end of December 2025 here, they'll say, okay, we're paying our dividend. But if all was the same, if it was 179% back here as it is down here, you would have gotten a much bigger dividend because it had been 179% of based on $136 instead of 179 based on $41. Well, that's one thing to understand. Number two, when you see a company with a yield and it's like, oh, it pays a 5%, say it pays a 5% yield. Fairly common with a lot of stocks, 5%. And yet you see that the stock ticker has dropped, let's say 6%. When you look, no, correction, let me back that up. Let's say that, let's say the yield was 5%. But the company dropped 4%. It went from $100 to $96. When you look at the 1-year return, notice the word return, it'll show 1%. So wait. Shouldn't it be negative 4%? No, because the yield lifted up the value. The yield is factored in to the word return. All right? So there's price change and there's the annualized return change. And when you look at most of these types of platforms, they will talk about the return, which puts the let's see, where is it? Where's the 1-year return? Ratings, expenses, dividends, liquidities, whatever. Oh, no, it is down here somewhere. Anyway, I don't know. I don't remember where it is. The point being is, they'll show the 1-year return, the 3-year return, the 5-year returns, and all that kind of stuff. The point being is that you have to be careful of the word return because that adds the dividend into it. Even though the stock is going down in value, the return could show positive. Be very, very careful of that. Okay. And that's what we call the dividend trap, where they come up and they say, but this stock is paying 100% dividend. You can't lose with this thing. Yeah, you can if the stock goes to zero. So what happens when a stock is going down in value but paying a high dividend? Well, they're giving you your own money back. You gave them $100 and they send you back $5. The stock is going down, but they say this $5 is a dividend, and you get taxed on that. And you say, wait, this is my money. They're giving me my own money back, and I'm getting taxed on it. Yeah. That's the con of a lot of these flashy dividend companies. And I mean, it's not always that way, but you have to be careful. Talk to your accountant or somebody like that and say, look at this and tell me, is this a good deal or not? Because many, many times, a lot of these companies, and I'm not saying that YieldMax is a bad company. By no means, I'm not saying that. I don't know that much about them. So I'm not targeting YieldMax. I'm just using them because they're, one of the flashy names going around now. And they may be a good company, bad company, I don't know. But there are lots of companies like Yield Max out there saying they're paying these awesome dividends, and a lot of it is simply clickbait to get your money, and they win because they get an expense fee, and you lose your money regardless. Okay? Keep that in mind. Now let's talk about your opponents. Who are your opponents? Institutions and retailers. And institutions break down into two categories: a planned move that they have in mind already, and then the algo that just runs in the background and does certain things and is looking for little small plays along the way, and definitely there for emergencies, unexpected news when everybody's gone home. And then you got the retailers. So let's start with the institutional moves here. Institutional moves come generally three categories. Now the first one, actually I'm going to change the order here. There are a lot of news reports that come out at 8:30 a.m. Eastern Time, like your CPI, your PPI, your whatever, all kinds of reports, ADP payroll, non-farm payrolls, all these kind of things typically come out somewhere between 8 a.m. and 9 a.m. Eastern Standard. The institutions, all of them, expect a huge move, and they will participate. They have a game plan ready to rock the microsecond, literally, that report hits the newswire. When the CPI comes out, a lot of times it doesn't matter if it says that the inflation is going up or going down or steady. The institutions have a move that they plan to make, because this is one of three times when the institutions come in as bulls, not bullish, but bulls, that they're going to, or let's just say football teams. And the institutions are going to come in as football teams, and they're going to play against the other institutions on the field. So I think I used this analogy earlier, but I want you to imagine 4, 5, or 6 individual football teams on the field at the one time. And let's say there's 6 of them. 3 of them they're trying to go towards one field goal. The other 3 are trying to go to the other field goal. We'll call one group bullish, one group bearish. But understand that the 3 that are bullish are also competing against the 3 that are so if you got team A, B, and C, and A, B, and C are the bullish teams. Not only is A trying to be bullish, it's also competing against team B and C. So team A is actually competing against B, C, D, E, and F. The same can be said for team F, which is competing against A, B, C, D, E. Well, the thing of it is that they've all got their plans when the news comes. If they're all coincidentally on the same, maybe they all actually are all going to be bullish today. All 6 teams, let's say, are thinking bullish. Then the market just rips to the upside and just keeps going. Or maybe they all happen to be bearish and the market just dumps. But most often, some are bullish and some are bearish. The question is, where's the more weight? Somebody's going to run out of money before somebody else is going to. And so when you come in, you'll see the price go up and down, up and down, down, up, down, up, down, 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 up, down, 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 and then finally it'll settle down, and it may either go bullish from there or bearish from there, or in a lot of cases you'll see it literally just goes sideways exactly from where the whole mess started. So the institutions really don't care what the news is unless the news is way out of bounds. If they said that the consumer price index, and I don't remember what it was lately, I'm going to say 3.1%. I'm just making up a number here. So if it's 3.1, it was past, it's expected to be 3.1. Well, if it comes in at 3.0 to 3.2, they're going to go with whatever they had planned to start with. But if it comes in 3.8, they have a backup plan that is going to override what their original plan was, because that 3.8 is way out of bounds of expectation, right? So we don't know. When we hear about there's the CPI report or the non-farm payroll report coming in the morning, we don't know what the institutions are going to do. They usually have something in mind, but it has nothing, listen to me again, nothing to do with the news itself, unless the news is way outside of expectation. You can say, well, we got a fantastic CPI. Inflation went down, man. You know, the market should be going up. Why are they dumping? It's because the move had nothing to do with the news, except the timing of it. The timing is the time when all the football teams agree to start the play. That's it. That's it. So you have to be very, very careful about expected news. Now, the other two times that the institutions really do a big deal is market on open. The 9:30 a.m. Eastern Time market on open for equities. What happens is at 9:25, lots of institutions will send in their stock trades, Tesla, AMD, NVIDIA, whatever, and those orders are to be placed at 9:30 sharp. The moment the market opens at 9:30 Eastern, they already have a queue of institutional orders about buying and sell orders for stocks. And so they just they hit the book automatically. And that's why we see for that first 3 to 5 minutes just total chaos a lot of times in the markets. It's because all these were programmed orders and they're finally, hitting the books all at one time. And the market makers are trying to sort it all out. All right? Then there's a market on close. And that's the last 5 minutes. Some people say it's the last 15 minutes. It technically is the last 5 minutes of the trading day, when the institutions put in saying at the end of day, within the last 5 minutes, we want you to buy this stock or sell that stock or whatever. And that, again, that is why we see a lot of chaos in that last 5 to 15 minutes there from 3:45 to 4 p.m. Eastern Time. Okay? But then the institutions have algos, computer programs that just simply run when, people are really not paying attention to the markets that much. And this is a little computer bot that's making little small trades here and there to just, make a few extra bucks, right? But also, the algo is programmed to watch for something major by news or a sudden change in the stock or something like that, and it's given instructions on what to do. Let's just say that at this particular moment, we've got issues going on with Ukraine and Russia. We've got Venezuela and the oil business, and whatever. So there are several international incidences. Of course, there could be some terroristic kind of activity that happens to a political figure or something like that. And that can cause, in the after hours, a stock that is trading, but not a lot of people are trading it. But all of a sudden, this horrible news comes out. Those algos see that news, and they will start moving those tickers all over the place. They'll start moving that stock whatever way they're programmed to do it, because they're there to guard, guard the house while everybody's asleep. All right. And then finally we got other retail traders. Retail traders can have an influence on stocks with either low volume stocks, penny stocks and stuff like that. And we've also oftentimes called that the pump and dump, because a lot of these smaller stocks don't have a lot of stock out there. It's easy for someone to come in, and remember too, some of these stocks are 50 cents a share. Not $50, not $500, but 50 cents a share. Well, it's easy for somebody to come in with $1,000, and that would mean they could buy, 2,000 shares? Blam! Drop one big order, 2,000 shares. What does that do? It drives the price way up. Well, other people see this and think the stock is running, and so they pile in too, and the stock keeps going up and it keeps going up, and then the guy that dropped his $1,000 in there all of a sudden sells, and then this big 2,000 stock sell order comes through, and all of a sudden now the price dumps and plummets and plummets and plummets. Well, all those people that got in at the end got in at the high price and lost. And they're called the bag holders. And that's why it's called a pump and dump. Somebody intentionally runs a stock price up to get other people excited to get into it, knowing that after these other people get into it, that they'll get the price to go up even higher, and then the person that started all this stuff dumps their shares to make a nice profit, and everybody else gets left holding the bag. Okay? So but you can also see that sometimes retail traders, it's not always so devious like this all the time. Sometimes it's just, in the after-hours session, there's just not as much volume. And so anybody that comes in and throws any amount of money, even if it's legitimate, can move a stock in the after-hours in some cases. Another way that retailers can manipulate, move, whatever the market, is to use options. And this is what happened with the famous GameStop story and a guy whose handle is Roaring Kitty. And he got a bunch of people to use options against GameStop, and they moved the price of the stock astronomically by using options to do that. And a lot of people bought actual stock, but so it was a mixture of stock and options, but they were able to just totally move the entire value of GameStop. It's an amazing story. So, all right. However, during normal trading hours, retail traders make very, very little impact on the price of most stocks, because the institutions are throwing thousands of shares at it, where most retail traders are throwing dozens. So here's an idea of what happens when institutions are aligned. Right here is approximately the 8:30 candle. Whatever that news report was on that day here for the ES, the S&P futures contract, whatever that report was, it came in, and all the institutions agreed that they were going to go short. So they all sold, and the price plummeted. Well, why did they do that? You can see what happened throughout the day, because, they sold 100, they sold 100, they sold 100, they sold 100. They bought 200, 200, 200, 200, 400, boom. Then it just so happened to be that they all kind of agreed. Now remember, they're competitors. But it just so happens to be that they pretty much all agreed that they were going to go long, purely coincidental. They all went long here, and so these guys got all their money back, plus they bought all this down here at a cheap price, so that when this happened, they cashed out. Here's the cash out cycle right there, and now they're done for the day. They're done for the day, and they made a lot of money. Okay? But here is where we see institutions are opposed. Some decided to go long. Some went short. Some went long. Right? Now, a lot of times we'll also see it can be within the same candle. And you just see this tiny little body of the candle with a great big wick up and a great big wick down. But remember, the institutions are competitors. They're not sharing their plans by any means. So, it's a question of who runs out of money first. That's really what it boils down to. All right, base hits and home runs. Let's wind this down. Base hits. You get a lot of people that come into trading, and this is the hare versus the tortoise kind of argument. Here's your tortoise, base hits, smooth and steady, just keeps moving. Made $50 today, made $50 tomorrow, made $50 the next day. Okay, we made a lot of money. Let's go up to $60, and then $60, and then $70 or whatever. And over time, they build their account. They're not really that stressed out about it. They're not putting that much at risk. But it is something that they have to be consistent. Then you got people that are excited to be traders. Oh, they're excited. And they get what's called a YOLO. You only live once. AKA lottery plays. If you want to do a YOLO, you need to be 100% prepared and willing to lose 100%. 100% of what you put into that trade. If you buy if you're into options, people who trade options know all about YOLOs. That's a big thing with them. And so maybe they buy a $5 option. They literally have $5 plus commissions into it. They don't care if it wins or loses. They're buying a lottery ticket. They fully well know that the odds of winning are low. They also know that they do not expect this to be anything that is repeatable on a day-to-day basis that's going to make them a lot of money. Right? It's not going to replace their day job. The point about home runs, too, though, is a lot of people when we talk about having a plan of where you get in, I get into the trade here, and I'm going to get out of the trade there. Well, sometimes there is the moon. And you got to be realistic about what's a proper place to get out of a trade. Realistic, because the further away you move, the lower the odds, right? You get into your trade, it's working out in your favor. You've got good odds it'll make it to point A. Not quite as good odds that it will continue to point B. Even less odds that it'll continue to point C. You need to learn, get out while the getting's good. Okay? Home runs are purely coincidental for the day trader. For a good seasoned day trader, it's a trade where the day trader gets in, he gets in, and now I'm just making up some numbers here. He gets in at 100, or she gets in at 100, plans to get out at 110. The markets go crazy, and next thing you know, he or she sees that it's running, and he lets it run until it gets to 120. And he gets the home run purely by accident, timing, coincidence, right place, right time. That is home runs for a day trader. Not somebody that's going to, but beyond that, no, we don't do that. So, alrighty. That kind of wraps up this presentation here. I hope you guys are getting some benefit out of all this kind of stuff here. And we will continue here. Now, the next parts 3 and 4, is an older video. It's about a year and a half old, where I review stocks, ETFs, futures, stuff like that. And what the differences are, what they have in common, options, and all that kind of stuff, where they differ, and so on. So Really good if you're not sure about where you want to be as far as doing your trading. That's a two-part series, very, very good to kind of give you some help with that. So with that, I am Marziti, your host. I'm signing off. You can always find me over at the Bullish Bears Discord group here, and if you're looking for a trading group, check out bullishbears.com, and we have a Discord group over there. It's active every day, and I am not a moderator or financially compensated anyway. I'm just a member, but it's a great group of people. And with that, signing off, be good, or at least be good at it. Bye-bye.